Setting a protective stop loss, or at least knowing where you'll exit your trade, is one of the most vital aspects of trading. Now, your stop loss defines your risk in the current trade, which will allow you to position size correctly. For the most part, traders are going to use some type of price structure when they first enter their position. And before I forget, can you hit like and subscribe to our channel here? Leave a comment at the end if you have any questions as well, and I'll get back to you. But yeah, hit subscribe. So a common example is a breakout over resistance and then a pullback. So a trader enters when price reverses, and labels 1 and 2 define the general locations a trader will use for an initial stop. But when the trade moves in your favor and you're looking to push your trades, how can you define your trailing stops? Well, there's a few indicator ways to define your stop location, but price action generally is the best approach. A common approach to stop loss placement is just using a swing point on the chart. But you should have an objective way to determine what constitutes a swing point in the market. Using a 5-bar or a 7-bar price pattern will help you become more disciplined in your approach. So the idea behind this pattern is that you're moving your stop loss once price is confirming it's resuming the trend. Now, granted, this confirmation may only be for the next bar and price crashes back down. Now, that's trading. Now, the 5-bar will give you more opportunities to lock in profits, while the 7-bar is going to take a little bit longer to form. So in the example graphic, we're assuming that the bars to the left of that green number 1 have lower lows coming into the bottom and higher lows coming out of it. This is a conservative approach. And you got to choose whether you're going to use a slightly more aggressive pattern. So you can see this version of the pattern is not as strict and only requires the lows for long to be above the main number 1 bar as opposed to being consecutive. So let's take a look at a 5-bar pattern stop using a chart of NEO, and we're just going to assume that you shorted this stock where it says short. I've labeled that. The initial protective stop location is above the swing high that was just prior to the entry. So at number 1, we have the conservative level where the 2 candles on either side of the highest candle are lower. At number 2, we see the aggressive example where on the left of the high candle, we have a lower high, but a higher high precedes it. A trader might decide to use the conservative right after the entry and then change to the aggressive stop loss zone after price is advanced. Now that makes sense because price has been on a trending run. A trader might want to be more aggressive locking in their gains because mean reversion is a real threat after price is extended. The snapback in price is pretty common. This example here has an aggressive adjustment as the first zone. If you're using the conservative and the aggressive method, you would skip this first zone and you would just wait for that conservative one that shows up at number 1. Personally, using the aggressive approach with a buffer under or over the middle candle is my choice. And for that, just use a multiple of the average true range for your buffer zone. For example, if the ATR is $1.60, 1 ATR would be $1.60, while 0.5 ATR would be half of that, so an 80-cent buffer. Looking at the 7-bar pattern, all we're doing is adding 1 more bar to each side of the middle bar, so it gives us 3 on each side. Again, you can be strict and only look for the conservative swing points, but you could be guaranteed of leaving a lot of profits on the table when this happens. Number 1 gives us our first trail on the protective stop using a 0.5 ATR. That's our buffer. Now the buffer is important because price, when it returns to the level, has a tendency to dip back into a previous range. We get another 7-bar adjustment. However, since the low of the candle minus the 0.5 ATR would move the stop further away from price, we're just going to leave it where it is. This last example is going to be a recent chart of crude oil futures. It's a pretty popular instrument to day trade. We're going to use a 7-bar pattern. The short trade comes after a gap down in the morning, a pullback, a trend line break. So after we get our first placement, we get a pullback. However, using this one, we'd be moving the stop further from price. The stop at number 2 is the next zone, and you would have locked in 4.25 points or $4,250 per contract. This is a simple approach to trade management, and it's grounded in the reality of the market. You have an objective way to lock in your profits using price and not a derivative price as you would with a trading indicator. And you can approach it from the conservative side, but I think you're going to find that through testing, you'll probably end up leaving too much profit on the table. What's important is that you can be as objective as you can with any trade that you're in. You have a set plan that you can use, which, to the downfall of most traders, it's not as common as you may think. They have no plan. So test this objective way out to lock in your profits. And it's going to take out any greed or fear that you may have. And you actually may find that your ability to stay in a trade actually improves which just leads to greater profit. Appreciate you watching. Thanks for listening. Hit like, hit subscribe, and again, any questions or comments, pop them below. We'll talk to you soon.